Hello everyone. In this video, let's learn about new issue market. New issue market. Stocks available for the first time are offered through the new issue market. The issuer may be a new company or an existing company. These issues may be a new type or a securities used in the past. The new issue market. The issuer can be considered as a manufacturer. The issuing houses, investment bankers, broker act as the channels of distribution for a new issue. They take responsibility for selling the stocks to the public. Shares, bonds and debentures are the avenues which are available for people to invest their money. There are two major markets, that is primary market and secondary market. The people can purchase securities from either primary or secondary market. Primary market is a place where the securities are sold for the first time by the companies. If the security is new, then it has to be sold in the primary market. The company, either it may be a new company or an existing company, if they are selling securities for the first time, then they have to sell it in the primary market. Therefore, it is a market where securities are directly sold by the company to the investors. Here, the issuing houses, investment bankers and broker act as a channels of distribution. They help in the transfer of security from the company to the investors. Functions of primary market: origination, underwriting and distribution. Origination deals with the origin of the new issue. The proposal is analyzed in terms of the nature of the security, the size of the issue, its timing and the method of the issue. Origination means starting or beginning. The beginning of issue activity takes place in the primary market. Here, the analysis takes place that is related to the nature of the security. What type of security is going to be offered by the company, that is decided in primary market. The size of the issue, the lot size, the number of securities that is going to be issued by the company. Then the timing of the issue, when the company is going to make the issue, and the method of the issue, in what way the company is going to issue the security. Everything is decided in the primary market, that is at the origination process. That is the first function of primary market. Second one, underwriting. Underwriting contract makes the share predictable and removes the element of uncertainty in the subscription. Here, only if the minimum subscription level is met, a company can issue securities to the public. It leads to uncertainty. No company can certainly say that the securities will be purchased by the public. Here comes the role of underwriters. Underwriters are the guarantors who provides assurance to the company about the subscription of securities. In case the securities are not purchased by the public, they will purchase the shortage or the gap, then help the company to proceed with the public issue without any problems. This activity is undertaken by the primary market. Therefore, it is the second function of primary market. Third one is distribution. Distribution refers to the sale of securities to the investors. This is carried out with the help of the lead managers and brokers to the issue. Once the securities are sold by the company to the investor, it has to be transferred from the company to the investor. This process is undertaken with the help of lead managers and brokers, that is called distribution. So origination, that is related to the beginning of issue activity. Underwriting about guaranteeing about the public issue. Distribution, the transfer of security from the company to the investor. These are the three major functions of primary market. Methods of floating new issue. First one, offer through prospectus. Second one, book building. Third one, private placement. Fourth one, bought out deals. Fifth one, rights issue. These are the 5 ways in which a company can raise funds or sell securities to the public in new issue market. Offer through prospectus. According to the Companies Act 1985, application forms for the shares of a company should be accompanied by a memorandum. A prospectus gives details regarding the company and invites offer for subscription or purchase of shares or debentures from the public. The draft prospectus has to be sent to the stock exchanges where the shares of the company are to be listed and proposed to be listed. The prospectus should contain the details regarding the statutory provisions for the issue, programs of the public issue, opening, closing and earliest closing date of the issue, where the issue is to be listed, highlights and risk factor, capital structure, board of directors, registered office of the company, brokers of the issue, brief description of the issue, cost of the project, project earning and other such details. The first way by which a company can offer securities to the public is offer through prospectus. Here prospectus is like an invitation which contain all the details regarding the public issue. It helps the investor to get complete idea about the public issue. As per the Companies Act 1985, it is compulsory for a company to have this memorandum, that is prospectus, and this prospectus should contain all the details regarding both company and the issue activity. Here it should include all the details about the board of directors, registered office, the cost of the project, project earning, everything should be included. At the same time, they also supposed to include the nature of the issue, the closing and opening dates, the earliest closing dates, everything should be included in the prospectus. These prospectus help the investor to know about the public issue activity as well as help them to purchase the securities of the company, that is offer through prospectus. Second one, book building. It is a process of price discovery. It is a mechanism where during the period for which the IPO is open, bids are collected from investors at various prices which are above or equal to the floor price. The offer price is determined after the bid closing date. The issuer of the initial public offer discloses a price band or a floor price at least 2 working days before the opening of the IPO. The applicants bid for the shares quoting the price and quantity that they would be willing to bid at. After the bidding process is complete, the cut-off prices is arrived at based on the demand for the securities. The basis for allotment is then finalized and allotment or refund is undertaken. The final prospectus with the details including the final issue price and issue size is filed, thus completing the issue process. Book building, it is a process of price discovery. Here the prices are not fixed directly by the company, rather they are asking the investor to fix the prices for their security. Here 2 days before the opening of the IPO, that is initial public offering, the company will give a price band or a floor price. Floor price means the minimum price at which the company is ready to offer shares to the public. Here they are offering a price band or the floor price to the public 2 days before the opening date of IPO. They ask the public to bid the particular quantity and the price at which the public is willing to buy the security. Here if the public is willing to buy, they will give their bids. Once the bidding process is over, the cutoff price is arrived based on the demand. Once after everything is over, they will finalize and they will finalize the activity, and the final prospectus is prepared, including the final issue price by completing the bidding process. It is a price discovery process where the prices are fixed by the investors through bidding activities. Private placement. In this method, the issue is placed with a small number of financial institutions, corporate bodies, and high net worth individuals. The financial intermediaries purchase the shares and sell them to the investors at a later date at the suitable prices. The special feature of the private placement is that there is no need for underwriting arrangements, since the placement itself amounts to an underwriting. The terms of the issue are negotiated between issuing company and the purchasing intermediaries. A listed public limited company as well as closely held private limited company can access the public through the private placement method. In private placement method, securities are usually sold to financial institutions such as UTI, mutual fund, insurance companies, and merchant banking subsidiaries of the commercial bank. Here, under this method, instead of offering securities directly to the public, the company is offering the securities to certain financial institutions, small number of financial institutions. It may be mutual fund, insurance, or any other institutions. These financial institutions, they buy the security from the company and then they can offer them to the public on a later date. Here, this process requires no underwriting because these financial institution itself acts as a underwriters. It means they help the company to sell the securities completely to the public. Therefore, they act as a guarantor to the company. This is beneficial for the company because they can avoid the huge expenses of public issue. The expenses will be transferred to the financial institutions itself. That is about private placement. Next is bought out deals or offer for sale. Here the promoter places his shares with an investment banker, that is bought out dealer or sponsor, who offers it to the public at a later date. In other words, in a bought out deal, an existing company offloads a part of the promoter's capital to a wholesaler instead of making a public issue. The wholesaler is invariably a merchant banker or sometimes just a company with surplus cash. The sponsors hold on to these shares for a period, and at an appropriate date they offer the same to the public. The holding period may be as low as 70 days or more than a year. In bought out deal, pricing is the key. The bought out dealer decides the price after analyzing variability, the gestation period, the promoter's background, and future projections. Here, bought out deal, it is similar to private placement. Here, instead of selling the securities to few financial institutions, they are offering the securities to a particular sponsor or a bought out dealer. We can also call them as a wholesaler. They are going to offer the securities to the public on a later date. Here, these sponsor, they can hold the security for minimum 70 days or for a period of an year. Here, this method is almost similar to private placement. The only difference is here the pricing is the key. Here the prices are fixed by the sponsor based on the variability gestation period. Gestation period means the term between investment and the production or activities. This gestation period, then promoter's background, the future projection, everything is considered by the sponsor while fixing the prices for the securities, and usually they offer the securities to the public at a premium. The next thing is rights issue. Rights issue is a group of rights offered to existing shareholders to purchase additional stocks, shares, known as subscription warrant, in proportion to their existing holdings. These are considered to be a type of option since it gives company stockholders the right but not the obligation to purchase additional shares in the company. In rights offering, the subscription price at which each share may be purchased is generally discounted related to the current market price. The rights are often transferred, allowing to allowing the holder to sell them in the open market. In a right offering, each shareholder receives right to purchase a pro rata allocation of additional shares at a specific price within a specific period. Rights issue, here instead of offering securities to the public directly, the company is offering the securities to their existing shareholders. They are giving their existing shareholders the right but not the obligation to purchase the securities of their company. Here, rights but not the obligation means the choice is left to the shareholders. Either they can purchase the shares or they can reject. Here, under rights shares, usually the shares are offered at a discounted rate and the rights are given to these shareholders to sell them in the open market on a later date. The shares are issued at a pro rata basis. These are the 5 different ways in which the securities are offered by the company to the investors. First one is offer through prospectus, that is a prospectus like an invitation to purchase the securities of the company. Book building process, a price discovery process where the price is decided based on the bids of the investors. Private placement, selling the securities to the financial institutions. Bought out deals, selling the securities to their wholesalers or sponsors. Rights issue, selling the securities to the existing shareholders. These are the different 5 methods by which a company can issue shares in the new issue market. Thank you.